For more on what emerging markets are doing to stem the flow of money out of the countries, I'm joined by Max Wolff, Chief Economist with Manhattan Venture Partners. Max, good to see you as always.
Thank you for having me. A pleasure to be here.
So, Max, a number of emerging markets are taking what can be seen as a rather risky approach. You've got Saudi Arabia, for example, telling banks to tell traders that they're not allowed to short the rial, the currency. Azerbaijan, which is oil dependent and has had a rough time of it lately, is putting a 20% tax on any transactions that take money out of the country. Nigeria, another one that's putting limits on debit and credit cards in foreign denominations. Does this work, Max, or does this backfire?
So it very rarely works in the big sense of rebasing the economy or preventing people from wanting to run. The problems are many here. One is that it's hard to get international multilateral coordination, so people do get around it pretty easily. Also, it is a bit of a warning sign about how healthy things are going. And last but not least, probably the biggest one is it tends to be a shut the barn door after the horses have left. So you're usually deep into a crisis, which is hard to stem when you start doing these things.
Does it serve to disincentivize foreign investment, for example?
Well, it certainly makes people a little bit nervous. Usually at this point, you're not getting a lot of inbound flow. The problem, and we've seen various examples of it historically, is only the biggest, most powerful, most well-articulated countries can kind of pull it off. Otherwise, it's an invitation to go underground and hide what you're doing from a central authority, who then struggles to assert its authority, which is being often flagrantly violated by traders.
Well, we do have this problem of net outflows from emerging markets. According to the Institute of International Finance, there were $541 billion last year. So what can emerging markets do that will be effective?
Yeah, so we did see pretty aggressive estimates that 2015 would be much worse than 2014 for capital flight. And then the numbers that we did get from the International Institute there were far worse than we had expected. So clearly a real issue. And sudden downward currency movements can make things very unstable. They can make imported goods like foods, medicines, et cetera, very, very expensive. So something needs to be done. But you want multilateral agreements. You want statement policies coming out from IMF, World Bank. You want groups like Davos and the World Economic Forum to engage it. What you probably need to do is try to figure out a moratoria or a support. So often if the big global central banks will support a currency and offer a lifeline of dollar availability or yen or euro availability, it stems some of the crisis.
Why would they do that, though?
They do that just to shore it up. Anything that adds volatility and panic to a panicked environment contributes to a general downdraft in assets.
Well, you mentioned the U.S. dollar, and the U.S. dollar has only been getting stronger, especially with interest rates tightening. That can only exacerbate the problem, right?
Sure, but having a sudden strengthening of your currency is also undesirable. We're beginning to see some of the earnings season numbers coming out here in the U.S., and we're seeing, including Starbucks and some prominent companies, the very expensive nature of the dollar isn't so good for our companies that do about 45% of their business offshore.
But what impact would this have on emerging market economies that have dollar-denominated debt? That just got a whole lot more expensive.
Right, so whenever we have an economic boom for a while, it looks like a great idea to dollarize your economy. And then what happens is the United States will often be strong because money runs here as a safe harbor when your local economy is tough. And then what you have is your currency isn't helping you by weakening. It's actually strengthening when you need it to weaken because you've used the dollar. So I think we're going to see additional pain, and we see people fall off the dollar wagon because they need currencies moving down and ours is moving up.
Let's take this to a bigger picture. What is causing these currencies to weaken? Is it the China slowdown? Is it the commodity slump? What is the big factor here?
Yeah, so it's very popular to blame China these days, and there's probably some real factor from China being the second largest and fast-growing economy slowing. But the truth is we had an over-leveraged global economy that was too dependent on basically Chinese manufacturing, buying goods from all over the world and selling to Western consumers. We saw Europe get into trouble, and we saw this business cycle get a little out in front of itself and to last a little bit longer than is usually sustainable. So what we now have is a reset because there isn't unlimited time on free money because the Fed has started to normalize and because the cycle has run its course, and we like the booms, but we live in a boom-bust cycle, and the other side of that boom is perhaps a little bit more painful, but arrives pretty regularly like an unwanted guest.
What goes up must come down. Now, you mentioned China, and Goldman Sachs, they're warning that China's economic transition to a balanced, consumer-driven economy is really going to hit emerging markets very hard until 2020. Is this mostly a commodity demand decline or the yuan weakening? What is the reasoning here?
So I think there's both. I think the truth is, anytime you have a major structural shift in any economy, Chinese, American, French, it doesn't matter, it takes a while. So sometimes the markets get these lunatic ideas, which are popular, that there's going to be some seamless transition that will happen almost instantaneously. Not true. Part of what makes life interesting, but also not true. I do think that we've seen this super expansion cycle, not just, but led by commodities in the emerging market space. I think that's running in reverse. I think we'll see it normalize. I don't think it's going to be that long. I think the emerging markets are definitely the future, but I think they're going to take a 2 or 3 year difficult breather, and they're going to grow less quickly, and we're going to see those historical problems emerge, if in a less severe format.